Tracy McWilliams, I'm in California, southern. And anybody else, and then I'll do introductions. Shant, I know you're in the Silicon Valley or the Bay Area, correct, in California?
Yes, in Palo Alto. That's right. Hi, Tracy.
Bill, you're in New York?
Actually, today I happen to be in Paris, France.
Oh, okay. That's pretty far flung.
Bill, you're based out of Orange?
Oh, I'm based usually anywhere in the United States. I get around.
Okay.
Great.
Where does your dog live?
My kids live in different places, so we.
Okay, great. Well, good morning, everyone. Good morning, everyone. I'm really happy to be able to moderate this alternative credit panel with an incredible group here. Quick introduction. Evan Chrapko, he's the founder and chairman and CEO of Trust Science. He's in New York, right there, next to Kamil Homsi. He's the CEO of Global Realty Capital. It's a single family office in Dublin focused on alternative investments. I have Shant, which we talked about. He's in California.
You mean Dubai, not Dubai. Dubai. Close,
Dubai?
close. It's the same letter, just
He's in
extrapolate.
Dubai. Yeah, not double.
Oh, okay. Well, yeah, I know you guys have introduced your firm, so I'm going to keep it short and simple here. So Shant is a managing partner and co-founder of Sanctum Capital Management in the Bay Area. And Bill Timmerman, who happens to be in Paris right now, he's a managing director of an Xnergy international investment banking firm. So I think what I'm going to do is I'm going to start out and I'm going to ask the first question, really have Evan begin. Evan,
Tracy, can I interrupt for 1 second? Tracy?
Sure.
Tracy,
Yes.
can you introduce yourself? You've got quite a great background.
Okay, Tracy McWilliams, I'm in California. I'm a former investment banker and I have a firm and a single family office. I have a firm, Inspire Global Ventures, and we just launched our own venture fund in the Seed and Series A financial technology area. And the reason is exactly what Marty said before we began this panel. The opportunity, it's an opportunistic fund. And the opportunities in the fintech space, especially for companies that are scaling exceptional teams that can't get capital, is pretty opportunistic at this moment. So that's my background. So thank you, everyone. So thanks, Marty. So what we're going to start with is, let's start, Evan, what does your firm do and where would you like to be in the capital stack? And so we're going to start with you, Evan.
Thanks, Tracy. Hi, everyone. Trust Science is an AI-powered credit scoring service. It's a platform. We are currently focused on scoring consumers. That's alternative. The session that we're in here is alternative credit. And I think Marty invited me because while we can be in prime and super prime, we are focused on the bottom half of the market, or the lower 2/3 are underbanked and unfinanced. As a platform, it's global. We have patents issued now from China to Japan, Israel, Mexico, and elsewhere. And we are selling our service to lenders right now. So it's consumer finance companies or banks. It doesn't have to be subprime lenders. You have prime and super prime household names. Their branches are all over the streets here that are seeking to go deeper as they're looking for yield or market share, taking advantage of the chaos in the market. And that last point is important of the premise of the business and what we do as something that's AI powered. When there's this kind of chaos, the way that you're scoring or rating debt or borrowers for the last 2 decades or 3 or 4 decades isn't working anymore. And you're going into changes and volatility that hits you, overnight or within 36 hours. That kind of environment demands that you have a process or a platform that can respond in kind, including changing the models themselves. And we'll come back to the details on that a little later in the panel.
Sounds great. Evan, thank you. And since you are doing AI models, you really don't look at the capital stack. So, you look at it for your lenders. And that leads me to Kamil. So Kamil, same question. Just describe, what the firm does and where you would like to be in the capital stack market.
Good morning, everyone. As you said earlier, Tracy, and thank you for taking me to Dublin out of Dubai. I mean, I'd rather be in the summertime of Dubai. I like to be in Dublin.
I'm a
Fair?
fan of Dublin. McWilliams.
Me too.
So
Me too. English comes easy. We are a single family office out of Dubai, and we are global investors with a mandate on alternatives. And that's where we fit today, probably in this group and on this panel. We are heavyweight on commercial real estate on both sides, equity and debt, renewable energy, research and development, and also implementation. And I'm very hawkish on waste management on different projects, starting from recycling used automobile tires and on liquid hydrogen, the various colors of hydrogen that today we are discussing. And I disagree with my preceding panelist on globalization because I do not see it. And I can criticize him because him and I met several times and we are friends. So he are in good hands. I'm strictly LP, never GP, never co-GP. And been involved into private credit for many years, definitely much heavier in my allocation now in the last few years, actually since 2020, and not only since the interest rates start rising, because we have been seeing that the classic banks have been shrinking, and not due to lack of capital, but because of over-regulating. I will stop here for now, and I'm sure you have a dozen of questions to ask us, and I'm glad also to answer all the questions that Marty raised earlier to the speaker before Key on LTV, on capitalization, on mezzanine, and there was someone sitting there asked about mezzanine. All the questions that being in the trenches, and as a macroeconomist, this is what I do 3 meals a day. Happy to be here with all of you.
Kamil, thank you so much. We will actually be asking some of those deeper questions in a short time here.
Yeah, the difficult ones, not the easy one, please.
Okay, all right. Dan, can you also ask that question? What is your firm do? Where would you like to be in the capital stack?
Sure. Hi, Tracy. I'm Shant Sood. I'm a managing partner and co-founder at Sanctum Capital Management. Sanctum Capital is an alternative investment firm that makes primarily debt investments into mid to late stage technology companies. Unlike venture equity, venture lending is vastly underserved, and we believe there remains significant opportunity for high risk adjusted returns, especially in today's markets. My co-founder and I have been making investments into technology companies over the last 20 years and across 3 different business cycles. Today is an especially interesting time to be investing debt into technology companies, especially given the recent collapse of Silicon Valley Bank and a number of other banks that have left the sector. In terms of where to be in the cap structure, we are primarily a private credit fund focused on senior secured term loans to technology companies that have reached a minimum inflection point, and certainly happy to go into more detail on that. I look forward to our discussion. Back to you, Tracy.
Thank you so much. So Bill, same question. Tell us what your firm does and where you would like to be in the capital stack.
Yeah, I'm Bill Timmerman. I'm managing director of Xnergy Finance. We are a boutique investment bank. We deal with entrepreneurs almost only. They're entrepreneurs who are looking to raise money, debt and equity, which is why it could be interesting to anybody in the family offices, because we do offer an access to alternative credits or alternative equity investments. And the entrepreneurs are all stages, from A stage up to maybe 20 million, 30 million of EBITDA, i.e. the lower middle market. And that is the opportunity we offer for the various family offices. As for where to be in the capital stack, we're totally indifferent. We're selling whatever we can sell to you today is where we'd like you to be. Frankly, we no preference.
So, well, we're going to get into more questions on that in just a minute. So now I'd like to really talk about your own experience, and we're going to start with. So Evan, since you're providing models and AI for credit lending through your platform, can you talk about your process to evaluate borrowers' credit in the current market? And how have your algorithms changed from the past, and where do you see them going in the future? Like on the investment banking side, we call this the writing process. It's a little different now on the AI side. So can you talk a little bit about that?
Sure, thanks. Where things had been for decades and still are, FICO based, or the big bureaus that we all know as the tri-bureaus, Equifax, Experian, and TransUnion, you're looking at a lot of historical information. You're looking in the rearview mirror to try and make decisions about where things are going. And that's why when I alluded earlier in my comments to the need to have something that can be extremely responsive, if you're not on an underwriting process, I would say, that's capable of looking at what's happened in the last 3 days, let alone the last 3 decades, looking at what's happening in many other indicators. It's a dirty little secret of the industry that if you're scoring consumers, or if you're investing in something that is lending to consumers, the decisions on those loans were made on the basis of 25 to maximum 50 variables. Those are things that all of us have. That's why all of us, or most of us, have a credit score or file with one of the bureaus if you've ever had any kind of credit. And almost all of those 25 to 50 variables are something that they can discover about you. The reality, though, is, and has always been, but the technology wasn't there to track this, is that there are thousands of variables that go into every single person, and every one of our behaviors is based on a collection of all of that. Now, if you can't gather that data, if you can't process that data, if you can't make sense out of it, then it's just a theoretical or abstract conversation, which is exactly where AI was for 40 years. It's a 45 or so years old science. So what we and others are able to do now, and all the rage in AI, is I can look at those and discover and look at those 2,000 variables on you, and determine that in your particular case, that bankruptcy is not fatal to you being a good lender necessarily. It may be fatal on another file. And that has everything to do with what are those other 1,999 variables. And that's a big change. And we're also seeing it coming up now in small business lending. Same kind of underwriting considerations. If you don't have the technology, you don't have the data, you're going to make decisions on less. So if you're investing in something that's lending to small businesses, make sure that those decisions are getting made with platforms or technologies that are capable of looking at a lot more inputs and able to make sense of them in an intelligent way. I'm fond of saying that my customers, my lender customers, potentially your investees, don't have to have a thesis on where interest rates are going. They don't have to have a thesis on what's happening with inflation, because you can rapidly iterate if you've built a platform that can rapidly iterate those models, you can follow what's happening. And yes, we will overshoot a little bit at the top, and in the cycle undershoot a little bit in terms of model efficacy at the bottom, but we'll be tracking the conventional way of doing these assessments. And so underwriting assessments beget your investing decisions or investment assessments. The way that this is headed is going to end up in a place where what you're seeing with the generative AI, the subspecies of AI that's generative, you're going to see this changing or evolving almost in real time. It's already making a lot of risk officers around the world, I think, queasy. We're seeing a lot of times we're met with a stiff arm until you show them the data or they run you in parallel in a shadow mode for a while, and they realize that this is actually possible, it's real, and it's happening now. At the end of the day, the industry itself, whether you're looking at historical factors or you're looking at a hybrid, you're going to see that your grandfather's way of doing underwriting is no longer relevant.
Evan, thank you. It's just, this is just an acceleration of what's going on with AI and the modeling in every industry. So interesting to see where the future lies here.
Well,
Kamil,
it introduces its own kind of uncertainty. It's its own
does,
chaos.
and it has to be adopted, and so has to be an acceleration there. But so Kamil, which where, and I don't know if this is an easy question, so you're more than welcome to add on from the previous speaker. Where do you see the most attractive investment opportunities in placing debt in the next 12 months? And also with your extensive background in real estate, can you talk about why investors, family office should have real estate debt in their portfolio? And do you see that accelerating?
Thank you, Tracy. Well, on the debt side, there are two arms that I do in commercial real estate, where I do provide equity on a debt to equity and debt to preferred developers that build for single tenant brands in the United States. And this is a big business. And since 2019, we know that the single tenant brands have been increasing their positions, as many of the supermarkets and many of the grocery stores have been also leaving the market, as we saw the stress experienced by the retail industry. Some of those preferred builders, they develop from 30 to 45, what has been the highest I have seen among developers that I have financed in different states and different brands, starting from Walgreens to AutoZone and to Frito-Lay and all those. That's one, because due to the volume that they do, they cannot come up with the required down payment to secure for themselves a senior. And the senior, as Marty mentioned before, is in the 50 to 60%. That leaves an equity gap. So we provide some in equity, and when they do not qualify for the senior, we also extend the senior. This is a short-term lending, and it is not way overpriced. 10-12%. I know that Shant told me that their interest rates start higher, but when we spoke the last time over the phone, but for us, in order to make the deal pencil out, we stick to numbers that are feasible for them to continue and to continue doing. If you are building a single tenant in the Southern Belt, south of the Mason-Dixie, 6 months, you will have a turnkey. If the same product is done north of that, estimate 8 to 12 months. So you are lending short time and getting a good return, but at the same time, you're waiting for the dust to settle in all this volatility that we are living on different ends. That's one. The second, I also provide debt for workforce developers in the hot spots of the United States today. And the hot spots, everybody knows, where people migrated supposedly due to COVID, but those hot spots also had COVID, but they had moved for different reasons. We all know what they are. And also for the states that do not have income tax, that are becoming since then also very popular for people that can afford them. So for those developers, I have always an open arms, and we have plenty of liquid capital for them to have their projects moving forward. That's one. But we also provide debt for operating companies, especially companies. Someone mentioned earlier 40,000. You said key, right? As in a small medium enterprise, especially manufacturing companies. that have a vintage, that have contracts with government, or have export components on for many years. And I prefer always when the founders are and the management of the company have been steady and have been with the company for some time. And when it comes to underwriting, there is no one color fit at all. Sometimes it is about the asset, or about the corporation. Others is about the location or about the widget that they produce, and it is their financial history, not only the current financial. I mean, maybe some companies went through some tight times in 2008, but then they prevailed. I consider those a better client because they already have the experience. But at the same time, I never compare this cycle to previous cycles, because this cycle was hit by a pandemic, where every previous cycle that people refer to from the Depression to 1980, 87 and 78 was 78. The stock market crashed, the big one.
87.
87. Yeah, 1987, I think breakfast didn't work for me. So, and moving forward, the saving and loan, and then the dot-com, and then 2008, they are not the same. We were hit by a pandemic. None of us was alive in 1917 to remember what happened. We only heard about it. Some call it Black Swan, Spanish virus or Spanish pandemic, whatever they call it, we only heard about it. This time, there was a lot of not only volatility, there was uncertainty. Anyone who made a decision, wrong or right, I do not hold it against them, because we did not know. We did not know what's happening. So now we are coming to really a little bit of reality, and we are starting to restructure our activity. I like to, before I close, I like to break for the audience the private credit in the following. In the business, we call private credit as a big house, and direct lending is only one room in it. And I delineate 6 rooms into that house. I do have and I have them here right in front of me. I like to share that later with Marty, so he can share it with everyone that like to see it. We have direct lending, where it's the basic, everything that's done here, Europe, or in other places. And then my number 2 is real estate credit. And then number 3 is real asset credits. And now number 4 is the specialty finance. What is specialty finance? Everything else, financing transportation, financing train cars, financing construction material, financing cruise ships, and everything else that is not commercial real estate, and it is not a operating company. And number 5 is my favorite for today, that Tracy asked me, Kamil, what is your position that you like to be at? I always say mezzanine. And I said that to Shant, to all my friends on the call, when I told them that in mezzanine, you have a priority over the common equity in case. And also, if you negotiate equity warrants for at exit, you also build an extra revenue stream for yourself, unless at the end of the day you just foreclose on the asset if it is a company or real estate. The last but not least is distressed debt and specialty and the special situation. I will leave that for all the servicers and to the whomever the banks and the court assign, but we will see a lot of that. Some call it hurricane. Key, what did you call it? You called it something, not hurricane. The hit that is coming. Yeah, or the gentleman before you, he called it something that
Apocalypse.
Apocalypse. Okay, I mean that brings me back to Hollywood and to Martin Sheen. I don't see an apocalypse because for the last year and a half, due to my network in the industry, I've been offered notes. I've been offered notes of office buildings in Midtown Manhattan. But what happened is the owner of the property is a good friend of mine. I've been in his house. I've been in the bar mitzvah of his son. So I contacted the guy. He denied. I said to him, look, you offered keys to your lender in New York, not far away from the jewelry district. And he said, no. I said, how are you going to work it out? You're going to have to come to some reality. mark to market is the future of most of those office building owners. If you don't come to mark to market and ask for an equity injection from a strategic partner, not a partner who only write a check, a partner who has the connections, in the financial market, and also can help you to continue the management operation. That will be a strategic partner for you. And there are many of them. There is so much dry powder here in the States. Look, I am a foreign investor and a non-US taxpayer, take advantage of all the incentives, but I know through my connections here in the States, there is so much capital. The banks can go on the side. We were in Davos, and when Jamie Dimon said that he knew that what was coming and everything else, but in that small round table, someone mentioned to him that you are not the only lender there. There is so much money in the US, and a lot of that money is going to come to replace the banking industry. I'll stop here because it's not fair for my colleagues that are waiting to share their view on the matter. But there is a lot that we can discuss. I'll be here for the rest of the day.
I have one question for you, Kamil, which is that when you say there's so much money on the sidelines, aren't people just putting their money into T-bills or tips? I mean, there's other alternatives for getting a safe return on investment versus, and I know real estate has some tax advantage aspects, but thoughts on that?
As we all know, the one who is going to put the money in the T-bill is the person who is going to compare the T-bill to a Walgreen ownership that has a lease of 25 years plus 5 years, 5 bumps. So that total 50. So here in the T-bill, I am in it, and it can be liquid at one point where the lease I have and I own because I need a fixed income. But if you are looking for the difference, we all know the difference between making a living and making money. If you want to make the 5 1/4, then I would say to him, to that person, especially if that person is of age, I say take the T-bill, or take the CD with the bank. Many banks today are offering from 4.5 to 5.5. I see the signs when I walk in Manhattan. So, excuse me. For that, Marty, I would say it is on a case by case. But if you are looking really to make money, there is a lot of money to do, because take for example the credit or the debt funds in 2018, they were in the high single digits return. Today, because of the floater that is to the benefit of the investors, they are between 13 to 14. So would you still take the 5 1/4? So it is a choice.
On a floating, but why? So why are you offering it at 12?
Well, because I want this. No problem. First of all, we are patient capital. If I come across as a free gambler is one thing, and if when I come in as a single family office investing the family money where all the members, they know where I live and they can come and knock on my door any time of the night and say, Kamil, what's for dinner? I say 3 o'clock in the morning. Say, I'm your cousin. I don't need to call you. So for those, 10 to 12 is continuity, being patient capital and long-term hold. I am satisfied with the 10 to 12 and maintaining the relationship and the loyalty of those preferred builders, because they have business until the end of my life plus.
Okay.
Thank you. Kamil,
Marty,
thank you. That actually helps transition into Shant, who's going to, so I appreciate that, because it is a specific mindset and how you invest to keep your loyalty in your clients. And it really transitions into Shant's question, which is, since your firm is an alternative investment firm versus the more typical venture equity, can you talk about how your strategy complements venture equity in today's market, which before today's market, venture equity was just, it was the place to be. And then could you also briefly talk about your underwriting process?
Sure, thanks, Tracy. I think you've said it well. Venture equity was the predominant and the go-to form of financing for technology for a very long time. And obviously, everybody's familiar with venture capital in the last 5 years alone, $1 trillion has flown into into technology companies by venture equity funds. There are over 3,000 venture equity funds in the US alone. So that is certainly the form of financing that every startup thinks about, or most startups do, and it's certainly developed into a form of financing that extends into the late stage, pre-IPO, post-IPO as well. However, in today's market environment, if you are a well-performing technology company, you don't have a lot of options when it comes to raising capital to continue your growth. So the IPO and the M&A markets are muted. Silicon Valley Bank, which is your go-to lender, has recently collapsed. There's massive valuation volatility in the public markets, which have now filtered into the private ones. And then finally, your venture equity investors are not only seeing a pullback from their LPs, so they're raising smaller funds, but on top of that, there has been a significant mark-to-market adjustment across their portfolios. So again, if you've got the mindset of a technology company that's growing very fast, you need to think about other forms of financing, and especially as you make it through the next 18 to 24 months of increased volatility and potential recession risk. In that environment, if you have that backdrop in mind, the preferred type of financing is a flexible capital provider that is not the traditional commercial bank, and that is not the mark-to-market venture equity. And right in the middle is what we call venture debt. And I think the first thing I'd like to do for my audience is just to disarm that word venture in venture debt. That is a significant misnomer. The real way to think about it is that we are a private credit fund that's focused in the lower middle market, but we only focus on technology companies that have achieved a minimum level of scale. So that's a bit of a mouthful, but to put it another way, if you're a technology company that has achieved at least $15 to $20 million of high quality revenue, you're being valued by the venture equity community at about 200 million plus. And certainly a lot more if you were born in 2019 or 20. In that world, we are, the venture debt community is a form of financing that will invest capital in you to the tune of about 1 times revenue, so about 20 to 30 million. In that, and that type of capital is far more flexible than what a Silicon Valley Bank or a Comerica might be able to provide, and it is far less dilutive than what venture equity might provide. So in today's market environment, where you've got all of these massive forces that are headwinds to your business, where capital is scarce and some of the typical forms of financing have evaporated, the preferred form of financing is venture debt. And in fact, the vacuum that has been created creates an enormous opportunity for venture debt funds like Sanctum. If you just step back, there are about 2,500 plus 3,000 plus venture equity firms in the US. There are only about 10 to 15 venture debt funds in the US. That's it. And these are the funds that have performed over time. Now, you've certainly seen very large funds that have dipped their toe in the water. So I'm talking about Blackstone and KKR and Ares, but there are really only about 10 to 15 funds that have continuously performed over the last 20 years. And in fact, if you look at their performance over the cycles, their loss rates have been minimum, less than 1%. And their typical yields have been north of 12%. And that has been time tested over cycles and across a bunch of different funds. So again, I just want to disarm the word venture in all of this, because ultimately you're talking about an asset class that performs way above typical private credit, that has a loss rate that almost doesn't make sense, but it is actually tried and tested and documented. So in terms of Sanctum Capital itself and our focus, we make senior secured term loans. Our typical credit yield is 11 to 15%. About 8 to 10% of that is just current cash. So you're getting cash back on a monthly, on a quarterly basis. But because we happen to be investing in technology companies, we also pick up exceedingly valuable warrants and equity investment rights. So if you're a Series B company and you're growing at 50% top line, you've got a fantastic gross margin, and you're providing a mission critical type of technology, you will have significant value accretion over the years. And so when we lend debt, we've got that downside protection in terms of the enterprise value and our LTV. but we also pick up the warrants, and those warrants can be quite valuable, especially if we're gathering the warrants in 2023 during the valley of technology valuations. So as I've often mentioned to my LPs, 2023 is a fantastic vintage for venture debt funds, primarily, again, because there's significant opportunity for deal flow. There's a vacuum created from a number of other sources of capital for technology companies. There's a natural lift from the rise in interest rates and the exit from a number of typical commercial banks that also creates value for us. In terms of underwriting, and I point to the very low loss rates, our underwriting is really driven by the overall enterprise value of the business. So we focus exclusively on mission critical technology companies. So these are companies where it doesn't matter what inflation is, what the jobs report says, if there's a war in another country, none of that really matters, because this technology is so fundamental to their customers that they have to pay that bill. A simple example is electronic medical record software for a regional hospital. It doesn't matter what the overall economic environment is, we have to pay that bill. And those are the types of companies we like to finance. So we dissect the revenue base during our underwriting process. While the venture equity community might value the company at 5 to 10 to 20 times revenue, we will lend at typically less than 1 times revenue. And that's what gives you a roughly 5 to 15% LTV. So again, in today's volatile market, we are senior secured, so we're at top of the cap stack, and we're lending at very low LTVs, and we're supported by a very high interest rate, a lot of which is current income. And on top of that, we're picking up warrants in today's valuation. So all in all, it's a super exciting time for venture debt, and certainly for Sanctum. And my competitors. We are seeing, I've been in this business for over 20 years, since the dot-com days, and I've never seen this kind of attention paid to this sector.
Shant, can I just interrupt here for 1 second?
Of course.
So, because I don't think you're talking enough dramatically about the marketplace and what's going on, right? So Silicon Valley Bank was 80% of the market, is that correct?
I think you'd have to include all commercial banks into the market as defined by venture debt, Marty. But yes, if you include commercial banks, yes.
Yeah, so Silicon Valley Bank, First Republic, Signature, 80% of the market, 50% of the healthcare market, et cetera. So they're gone. So the number of deals you're looking at has increased dramatically, and not only that, but it's the creme de la creme. Is that correct?
That's right. Yeah, the credit quality of the companies has gone up. They have about 2 years of cash runway before I put the debt in. We can ask for warrants, we can ask for covenants, we can ask for increased reporting. It's almost like everything is getting better from a lender standpoint for us.
Some people think that I'm sorry. So your target IRR, your loan is what? Prime plus 12, 13% plus warrants?
No, it's not prime plus 12. It's more like the all-in yield is around 15%, of which about current cash is about prime plus 200.
And so including warrants, your target is 25%?
Yeah, including warrants, plus we get equity investment rights into these companies. If you throw all of that in, you're now getting into the high teens, 20+%. And a lot of funds in my segment are levered. So even if you add just a half turn of leverage on the fund, we are now well past 20% on a gross basis.
So they're levered with some sort of warehouse line or something like that.
Right.
Lines from a hedge fund. Got it. Okay, perfect. So Silicon Valley Bank is gone. So the question is, some people are saying that this is a structural change. The bank type of lending won't come back in its prior form. Do you think that's correct?
I think that's correct. I mean, look, Silicon Valley Bank is not just a bank. It was actually a bank formed by the venture equity community many years ago. So they've got roots that extend into almost every aspect of the technology ecosystem. So by them suddenly vanishing, and even though they've been bought by another bank, you're not going to be able to replace that kind of architecture again, I don't think. And not to mention the sudden dramatic, I call it that dramatic weekend when Silicon Valley Bank announced, and you had a flurry of companies trying to figure out how to make payroll work. I think that has left an indelible mark in the minds of a lot of venture equity investors, where they now insist on diversification with banking relationships. So Silicon Valley Bank used to demand that every startup would have all of their cash with the bank, but that's going to change. And I think there's just a tinge of suspicion, I would say, around the commercial banking sector from the venture community, where they want to be able to have a more trusted, more stable long-term partner.
Keep on going.
And, so from that perspective, the equity that you're getting is attractive just because the market's valuation is, I just read an article this morning on the valuations of these companies. And the truth is, as Marty mentioned earlier, these companies are actually viable. They're revenue positive, they have exceptional teams, and it's just painted brush across the industry as a whole. So it's attractive to have those.
We have about 10 minutes left, guys.
Yeah, I think that's well said, Tracy. There has been a broad brush that paints every company the same way, and that's certainly unfair. There's a number of amazing technology companies that have gotten their valuations crushed due to exogenous reasons, which makes it a great opportunity for us.
Great, thank you. So Bill, as an investment banker, you have the ability, you're introducing companies to capital. What are you seeing regarding the demand in capital, regarding capital providers? And how has that interest and appetite changed in this current market, which we talked about on the prep call?
I think we've seen that there's been we see as a boutique firm, it's hard for us to judge a macro market, but we see constant demand, and we've seen more entrepreneurs come to us, more early stage entrepreneurs than we've seen in the past. We've seen, it seems, a dearth of companies with 4 to 20 million of EBITDA. There are very few of those around, and there's a huge demand for those. If we go out to 10 private equity people with a $4 million EBITDA, $5 million EBITDA company, we get answers back from all 10, which we would not have had a few years ago, which is also the opportunity for the family offices, because these are excellent investments. And in many cases, these are not competitive bids, because some of these are not always the most perfect company, but there's just a dearth of them. And so a family office that knows a certain niche, there are more opportunities than there ever were in the past. We've also seen that in debt. We've certainly seen, we don't even think of banks anymore. We think of venture lending, which we've come across a number, and we think of family offices. Actually, we go to family offices and offer them almost in priority, because they're one of the great sources of liquidity. So we've seen more interest than we have in the past.
So Bill, real quick, you actually look at providing debt and equity for any of these companies, whatever they need, you evaluate what they need, and then you find the right capital. Is that correct?
That's right. So we'll look at them, analyze it, look at where they're going, where they've been, and what we think the market will offer them. Since we're not giving the cash, we have to evaluate who would possibly invest in this company, who would possibly lend debt, and what terms, and that's our knowledge of the market that allows us to do that.
And are you able to place earlier stage companies come to you as far as capital?
To be quite honest, the Silicon Valley venture capitalists don't like investment bankers. So if we have an A stage company, is very difficult for us. We've gone to even family offices with A stage companies, but it's a difficult market to evaluate. Venture capital typically doesn't like us because we take a commission. They don't like to see their money go to commissions. So we prefer this. We've seen and concentrate on B or C stage if we're going to early stage. And even that is difficult. The bread and butter is that there's a huge demand from everybody for a $3 to $5 million EBITDA companies.
Thank you, Bill. So to wrap up here, let's, because we have most of our attendees are family offices. If each one of you could just talk about what products they should focus on regarding debt, real estate, et cetera, and where you think the opportunity is today. Briefly wrap up. And Bill, since you started that, do you want to make any other comments for family offices before we work our way backwards?
For family offices, I think they've heard today there's a wide variety of investment opportunities, and it's really their own risk return and liquidity preferences that they have to consider. The venture debt is obviously a great place. The real estate is a great place for today. This mezzanine debt could be very good, but they all have a risk return. And you have to look at that risk return in context of your own liquidity. And if you like that, then you have huge choices. So we have a preference for none. It depends upon the investor, but it's all out there.
Great. Thank you, Bill. Shant, you want to answer that question?
Sure, and I'm certainly in conversations with a number of family offices, and I think perhaps selfishly so, venture debt is a fantastic product for family offices, primarily because you get the downside protection of private credit. We are again senior secured with liens on everything on these technology companies, but because they're high growth technology companies, we also get the warrant upside. So we provide a pretty interesting alternative to investing in a venture equity fund that's generally long dated, that is generally taking the long risk on technology. Our funds are generally structured as 6-year funds. We invest the capital from day one, and there's interest income coming back from the first quarter. So you eliminate a lot of that J curve as well. So we think playing that upside, but with downside protection, is a powerful combination.
Great. Thank you. Thank you. Kamil, I know there's a lot of opportunity in this market. So if you want to give some ideas for family offices on what they should look at.
Thank you, Tracy. Well, due to time constraints, Marty is giving me a nod. I have 3 takeaways to share with those people who invest in commercial real estate. If you are a lender, and if you are a landlord and any of your lessees had a letter of credit guaranteeing their lease by a bank that is out of business, have your auditors look into that and see that that letter of credit is replaced by the new banker of that same tenant. But that will become an issue, that a tenant now can move out and no obligations or liabilities because you lost that letter of credit. The bank that had issued it is out of business. That's one. It's something that's important for people to know on this one. The second thing is, if someone asks, Kamil, you are a foreign investor and you are lending in the United States, what I want to share with them also that there is a provision and a code in the IRS book that is called the portfolio interest. The portfolio interest code is specifically made for foreign investors lending in the United States, providing they are not bankers, with a long list of prerequisites to qualify. Very simple, about ownership and about your background and the source of the money to clear with the Homeland Security and other departments. That is my advantage when I lend in the United States. Third and last, I would say to those who are in the commercial real estate, always diversify. And if you are co-investing with a manager, the best composition of a portfolio today is the core and satellite. Those who are in the business, they know what core and satellite is. And for those who are in the room, we can talk about it after this panel. Thank you very much, Tracy, for your moderating.
Evan, you want to say something?
Sure. I would say that if you're doing anything that involves debt, that involves consumer debt, and you dig 1 or 2 layers deeper, and FICO or something like that is being used to assess those borrowers, take another look, or at least get something else, get another view on that. That includes securitizations, so portfolios where you're buying something that someone else has originated. So that's where consumers are being involved. For myself, or to answer the question, I'm long upside. I'm a serial entrepreneur, returned nearly $1 billion to my family office investors. And so I'm one of these things is not like the others on this panel. Thanks for your moderating, Tracy.
Thanks,
Thank
guys.
you, everyone.